Hey, good morning, everybody. Welcome to Ankerstar Wealth Morning Show, and welcome to what I like to call the day after. Just like when a big storm rolls through or a whole bunch of turmoil happens in your life, there's that calming period afterwards. Well, when you're talking about financial markets, probably the biggest thing is for folks that are in the position as we are as managing money is waking right back up early again to check one thing, the futures, right? Because after a big down day like we've had, all we really want to see is at least a little bit of a bounce to the upside, meaning, pre-market we're in the green. Then the next, deep breath is that when the market opens, you kind of watch to make sure, okay, we're staying in the green. Then it's kind of like, okay, the bottom's in, which is a whole different strategy now versus if you have a big down day, futures are down, you open it up and either you get that head fake higher and it rolls over or it just rolls over from the start. Then it's a whole different ball game of decisions you have to make at that point. The team here, we talked about it a lot yesterday. We're kind of expecting like, okay, this to be kind of a one-day thing, kind of more based on Japan than it is anything fundamentally we're seeing here in the U.S. markets. But at least there's a lot of things we have to pay attention to. So we're expecting a bounce this morning. We got that. So we can now take a deep breath and focus on where do we need to go from here, which Mike's going to talk about today. He's going to start us off with a couple different topics. He's going to talk about the VIX. We talk about volatility of the VIX. It's kind of a weird animal, but conceptually, Mike's going to talk you through what it is and things we kind of watch for in the VIX because it really can kind of give you insights into the market there. Then he's going to talk about consumer confidence and where how that affects the markets as well as an indicator for future performance. So he's going to walk us through a bunch of stuff, and then at the end will kind of talk about some experiences yesterday, conversations I've had, and some of the sort of coping methodologies that are out there for folks when you have a big down day like this. So that's what we have for you today. This is a financial education presentation, so do your own due diligence before acting upon anything you hear in this presentation. More disclaimer information is available at ankerstarwealth.com. The opinions expressed are mine and Mike's alone, and let's start with Mike. So over to you.
All right. Yes, it's much more fun to report green. So, on my screen, you can see the Dow up, big number, 530 points. The NASDAQ and S&P up about 1.7%. And considering what the market did yesterday, it's already recovered almost a little more than half already from yesterday. So that is good news. And of course, we want that to continue. And I know all of you do too. So I thought I would look at this a little bit. And like when this kind of thing happens, like I always like to just take a step back. So I'm going to look at the NASDAQ, which we're heavily weighted with tech. This is the NASDAQ year to date. And you can see that had a great peak in the, I want to say it was July 10th. It was right around there. And since then it's come down, to put it in perspective, it's still up 8.9% on the year. And it's sitting right about where it was in middle of May. So, perspective wise, yes, it's nice to see it continue straight up without these sell-offs, but that's what we have. Anytime the market does what it did yesterday, that's what I like to look at. What has it really done? Because you get people like, oh, my portfolio's down thousands. Yes, it's down thousands from the high, but it's definitely not down thousands from the beginning of the year because it should be up. So, just a perspective. Another thing is when we look at things in the green and we hear the Dow's up 500 points and all that, and I typically say, I don't really look at the Dow because it's only 30 stocks. I thought today I would just pull up those 30 stocks and just show you real quick, like today when it's up, you can see like Caterpillar's up 4%. The Dow's up 3.7%, American Express, all the way down. You can scroll and see in the red, Apple, Intel, Boeing, they're down just a little bit today. So these are the overall Dow stocks. Some of these we hold positions in. For example, we added Nike to our Ego stocks. It's up 2% today. That's great. So it's just kind of good to see this. Sometimes you can pick up a little trend. There's some Salesforce, there's Intel, there's some tech companies in there. They don't have NVIDIA yet. Who knows? Someday they probably will. They'll probably drop out Intel and put NVIDIA in there. But it's just good to look at this overall perspective. Now, I'm going to go back to this first screen here. And if you, like us, you look at CNBC and you see green, 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 red. And usually red is bad, right? We're always like, oh, I don't like to see the red. This is the one box that doesn't really seem quite aligned with the rest. The rest are all stock performance. This last one is the VIX, which is really the fear index. And this is calculated. It's super complicated, but it has to do with put and call options on stocks 30 days out. And they look at the differences and they look at how they trade and they use some math and they come up with this number, but it's the fear index. And so what it means is when this number spikes up, people are in fear. I mean, and people are trading because they're in fear. So I'm going to show a graph of what this VIX looks like over here. I'll look at it just in a year. So there's a 1 year. So you can see in the past year, this is by far the biggest spike. That thing shot up. But let's back it up, and I'm going to back it up to, I'm going to use what's called all, and I just really want to look at it over the last 20 years. And you can see anytime this thing is shot up over, I'm going to say 30, about 5 or 6 times, you can see it happened in 2022 when the market sold off. It happened in COVID. It happened in the great financial crisis that happened in 2008 through 2011, and even back to like 2003. So these are massive spikes of selling and fear that we have. Obviously you can see by looking at this, it's not that crazy. It happens occasionally. But what I want to look at is how this relates to consumer confidence. Because when I show you this slide here from JP Morgan Chase that they supply us, and I love this slide because it shows you kind of, if you look at that blue line across the middle, that's the average consumer confidence, and it's like 85, about 85. Anything that's below means the consumers are less confident. And you can certainly see in, pick 2020, COVID, or 2022, you can see these dips where, and I'll say me as a consumer, all of us are not confident. We're like, things are bad. And of course, you'd like to believe, when things are at the top, like things are really good, how does the market perform? So when we look at these troughs, like when it hits its low points, like this is as bad as it could be. The consumer's like, oh, things are so bad in this economy. It's terrible. If you look at the percentage of the S&P 500 over the next 12 months, it averages a 24% return. So think about that. Every time when it hits that bottom trough, it's the worst. The market averages a 24% return. So some of that is due to when it seems like it's the worst, people are selling off and it presents a buying opportunity. So we are definitely underneath the average bar. Maybe we're not at a trough, but we're definitely below that. On the sad side, and this is surprising, when it's at its peak, where everybody thinks everything is so good, we are just rolling, it's going great going forward, the S&P 500 only averages 3.5% return. So it's still a return, but it's not near 24%. So the reason I point this out is a good thing. And you can see when these bottom troughs hit, they're typically around those VIX spikes. So if I pulled the VIX graph and I overlaid it, you'd see 2008, it went down, 2020, there's the drops. We're seeing this VIX spike here. Maybe this is an indication of good, or maybe it's an indication of fear right now, but good things to come. But right now we just don't see it. So I'm going to take it as the good side. Overall, consumer confidence is still below average. The economy, everything, even though markets, they were just at all-time highs on July 10th. But right now, the consumer confidence is still low about what's happening going forward. So we're going to take that as an opportunity that, things are probably on sale and a chance for us to, pick up some positions. Go ahead. I'll turn over to Steve.
All right, Mike, thanks for that. And, as you can go ahead and bring your screen down there, because I just want no slides for me. I just want to talk to everybody today. So these days will happen. And the only thing for sure is they will happen again. Sometimes they happen out of the clear blue. This weekend we had the Japanese news, and that, or it can be war in the Middle East, or it can be combinations of those things, or whatever it is. You can have pretty significant emotional events in the market where, I do make light of it, even though obviously this is our, life savings that are in this mechanism. But, markets, I like to say, none of us are as dumb as all of us. So when you get a lot of people in a market together, and if everybody's freaking out, it can make you kind of freak out. So when you look at your leadership team, thank you for your trust and confidence in Mike and I, as well as the rest of the team here. But one thing that we do offer is that cold analytical look at the situation, not just the emotions. I've known Mike obviously for decades. Mike is very analytical. He's got the charts. He's looking at them. He's interpreting them and presenting them to you. And then my natural skill set, I believe, is the fact that I don't really get wrapped up in emotional stuff a lot, so I can kind of see through the emotions of the moment and look at the longer term of we've seen this before. We're going to see it again. Thinking ahead of time, are things reacting in our portfolio like we expect they should, and then what are we anticipating for what's coming? So I just want to talk a little bit about that. We've got your back. That's why we got up early yesterday. Where we're talking at 4 a.m. We're slacking back and forth through our archive messaging system, kind of making our game plan. It's like, yeah, we need to get a video out before the open. And again, that's the purpose of these videos, is try to get things out in your hands and answer the questions that you're going to ask of us. What Mike's talking about, switch into on occasion, when you're out and about and people ask you what to do. If you say financial advisor, they like to run away, right, and stop the conversation. So I like to say therapist, because that's more of an interesting conversation. And people's like, oh, what kind of therapy do you do? And I'm like, well, I do financial therapy. And this is kind of breaking into the emotional part of this, or the psychological part of investing. Is days like yesterday, you learn a lot about yourself. There's the folks that like, oh dear Lord, put the phone down and don't look back, or might look back once with that kind of one eye peek, like, ooh, yikes. And then there's people that look at percentages, and there's people that look at the raw numbers. One thing I've been talking about with Corey, who we brought onto the team this year, is, yeah, a lot of folks are used to looking at raw numbers and versus percentages. And really, we look at the percentages of it, even though if you have a sizable account, that can lead to a big, large number. But really, managing to those percentages is what we're looking for. But in terms of the, therapist, psychologist that with folks, is we look at, this is what's called recency bias. Mike talked a little bit about, so talk about the, at its core, recency bias is what's going on right now is going to last forever, right? So yesterday's sell-off is things are going to sell off forever, so I need to get out. I did get a phone call yesterday for a, hey, let's move out of everything. And we were able to talk through that into, let's make some changes and analyze where things are the next day, and then go from there. So, but that can happen. So when Mike's talking about why are people buying in at the top or selling off at the bottom, that's exactly recency bias, right? And for those of you, I know I've had some frustrated conversation with folks that have been wanting NVIDIA in their portfolio. And we talk about that quite a bit, but back when it was way high, it was like, there's no way we need a pullback. It just never seems like you're going to get that pullback. Right. And that's the answer, is that, folks are like, well, how do you know there's going to be a pullback? And it's like, well, I don't know. We don't have crystal balls. But it's you generally do. And in fact, we did, we were buying in before this, downturn, but certainly today, even buying more. Right. So after yesterday's sell off. So that's kind of that tendency for folks to want to pile in more money when things are at the all-time highs, and selling when they're all at the all-time lows. And again, that's backwards from the situation. And also, despite everything that's going on, markets actually revert to the mean. So back to the kind of stats and the math of it all, when things run up and you have a 7-month bull market in an election year, sometimes things just sell off to revert to the mean of where we should be. So I think Mike said around a 9% up this year. That's kind of about right for a really good year. If you subtract what happened and go back to January 1st, and somebody said, hey, I've got a deal for you. You want to take door number 2, which is the unknown, or door number 1 that says you're going to be up 9% in August 5th or 6th, and you're going to be like, I'll take the 9%, please, halfway through the year, right? So again, zooming out, taking everything in line. So these can be eye-watering moments. especially when you look at raw numbers moving big. But what I will close with is what I like to say, that our main tagline is, of course, maximizing life through maximizing wealth. That's kind of the esoteric long-term goal. But the other one is, mission is rapid response to client concerns. We do want you to call us. Don't sit in the dark and get get in spiral on big days like this. We want the phone to ring. We want to talk to you. It's obviously a busy day, but you're not bothering us. So let's have a quick 2 to 3 minute phone call with hey, what's going on in the markets and what we think real quick. Won't be able to catch up on mom and the kids like normal, but certainly a strategic call. If you wonder what's going on, hit us up real quick. We'll answer those questions for you, and kind of talk you out of or talk you back to how this does happen and how normal the situation is and what we expect to happen the next day. So with that, lots of great information, Mike, from the analytics side. Hopefully you guys are still listening to kind of the psychological side, because that's the balance of the markets. And with that, go green, right? So sometimes you get these elevator down moments, and then you take the stairs back higher. It takes a while. But yeah, that's what we're kind of seeing out of today, and that's what I hope we see the rest of the week. So with that, we will catch you guys back tomorrow. You have a good one. Bye.